December 21st, 2025. The math behind the silver market is broken. Let's begin with a scenario. It is a nightmare scenario, but one that every serious precious metals investor has played out in their mind at 3 a.m. Imagine it is a Tuesday morning in New York. The time is 8:15 a.m. We are standing outside one of the heavily fortified, nondescript warehouses in the borough of Queens, a facility owned by a major logistics operator like Brinks or Loomis. This building is special. It is a CME-approved depository. It is one of the few places on Earth authorized to hold the physical silver bars that back the billions of dollars traded every day on the COMEX futures market. An independent team of auditors arrives at the gate. They have been hired by a consortium of institutional investors, let us call them the whales, who hold warrants for a massive amount of physical silver. They aren't interested in the paper price. They are interested in the metal. They have triggered a clause in their storage agreement that allows for a surprise inspection. They are here to verify bar list 4409. In the digital ledger of the exchange, bar list 4409 is boring. It is just a spreadsheet row. It represents approximately 2.5 million ounces of registered silver, metal that is supposedly unencumbered, sitting on a pallet, ready for immediate delivery. The auditors enter the facility. They pass the metal detectors. They pass the armed guards. They reach the heavy steel door of the main vault. They ask to see the specific aisle where bar list number 409 is stored. And the vault manager stops them. He doesn't have the keys. Or perhaps he says there is a safety protocol in effect. Or maybe he admits that those specific bars were moved to a segregated area for cleaning or assay verification. Access is denied. Why? Because the silver isn't there. This is the ghost inventory theory. It is the terrifying realization that the registered silver numbers published every day by the exchange might not represent physical metal that is available for you to take. It might represent metal that has been leased, released, and rehypothecated until it exists in 5 different portfolios simultaneously. If bar list 409 is missing, then the entire trust architecture of the global silver market collapses instantly. In this comprehensive breakdown, we are going to treat this scenario as our case 0. We are going to investigate the structural flaws in the auditing system that make such a scenario not just possible, but mathematically probable. We are going to expose the 400-to-1 leverage ratio that defines the modern paper market. And we are going to explain why the 40 million ounces of registered silver currently shown on the COMEX reports might be the greatest illusion in financial history. This is not a drill. This is a forensic accounting of a crime scene where the weapon is paper and the victim is price discovery. To understand the fraud, you first have to understand the rules. How does a bar of silver actually get into the COMEX system? The rules are set out in Chapter 7 and Chapter 1 and 12 of the CME Rulebook. They are incredibly specific. A good delivery bar must weigh approximately 1,000 troy ounces. It must be cast by an approved refiner. Brands you know, like Asahi, Valcambi, or the Royal Canadian Mint. When that bar arrives at a depository like Brinks or Manfra, Tordella and Brooks, it goes through a strict intake process. First, the weighmaster verifies the weight. The rules state the weight must be incised on the bar to the nearest 1/10 of a troy ounce. Second, the assayer verifies the purity. It must be at least 999 fine silver. Third, the bar is assigned a unique serial number. Once this happens, the depository issues a warrant. This is a crucial document. The warrant is the digital title to that specific bar. If you hold the warrant, you own the metal. In a perfect world, that bar sits on a pallet in the registered section of the vault. It does not move. It gathers dust. It waits for the warrant holder to come and get it. The exchange requires these depositories to submit to an annual inventory audit by an independent auditor. The auditor's job is to go in, count the bars, check the serial numbers against the warrants, and certify that the pile of metal matches the pile of paper. It sounds robust. It sounds secure. It sounds like a system you can trust. But here is where the ghost enters the machine. The audit only verifies that the bar exists inside the 4 walls of the vault. It does not necessarily verify who owns it or how many claims are stacked against it in the derivatives market. The auditor sees a bar with serial number 12345. He checks his list. Yes, bar 12345 is here. He ticks the box. But what the auditor doesn't see is the shadow ledger. He doesn't see that Bank A has leased that bar to Bank B, who has used it as collateral for a short position with Hedge Fund C, who has sold a call option against it to retail investor D. All 4 of them believe they are backed by bar 12345. But there is only one bar. This is the gap between existence and encumbrance. The audit proves the metal exists. It does not prove the metal is unencumbered. And in a financial system built on debt and leverage, unencumbered is the only word that matters. To deepen our understanding of this scandal, we must distinguish between the 2 categories of silver you see on the daily warehouse reports: eligible and registered. Eligible silver is simply silver that meets the purity standards and is stored in the vault. It is private property. It might belong to a wealthy individual, a family office, or a corporation. It is eligible to become a futures delivery instrument, but it hasn't been certified yet. It is essentially in storage. It is parked. Registered silver is the danger zone. This is silver that has a warrant attached to it. It is fully available for delivery against a futures contract. This is the inventory of the COMEX. This is the metal that backs the price. As of late 2025, the amount of registered silver has plummeted to dangerous lows, hovering around 40 million ounces. Here is the trick: the shell game that creates the ghost inventory. When the registered inventory gets too low, when it drops to a level that might cause panic in the market, we often see a sudden magical movement of metal from the eligible category to the registered category. Millions of ounces simply slide over in the spreadsheet. The narrative from the banks is, oh, a private owner decided to sell their silver, so they moved it to registered. But the ghost inventory theory suggests something far more sinister. It suggests that the bullion banks are leasing the eligible silver from the private owners, often without the owner fully understanding the implications, and reclassifying it as registered to pad the numbers. They are using your silver to suppress the price of your investment. Imagine you store your classic car in a garage. You pay a monthly fee. You think the car is just sitting there. But the garage owner is secretly renting your car out as an Uber every night to make money, then parking it back in your spot before you come to check on it. That is what we suspect is happening with eligible silver. It is being rented out to prop up the registered numbers. So, when we talk about bar list number 409 being missing, we aren't necessarily saying the vault is physically empty of all metal. We are saying that the metal sitting there might belong to someone else. It might be the eligible silver of a client, masquerading as the registered silver of the bank. If an auditor were to dig deep, if they were to demand the title chain of every bar, not just the physical presence, the entire scheme would unravel. They would find that the same bars are serving two masters. And the Bible teaches us you cannot serve two masters. Eventually one of them is going to ask for their silver, and the other one is going to be left with a ghost. Let's look closer at the audit failure points. We have historical precedent for how these audits can be manipulated. Look at the U.S. Treasury audits of Fort Knox. For decades, rumors have swirled that the gold is gone. When audits were finally released under Freedom of Information Act requests, they revealed a pattern of incompetence. Sample sizes were reduced. Auditors didn't check every bar. They checked a statistically significant sample. If you have 10,000 bars and you only check 100 of them, you have a 99% blind spot. In a fraud scenario, you don't steal the 100 bars by the door. You steal the 90,900 bars in the back. Furthermore, the CME rules allow for digital bar lists from LBMA-approved weighers to be accepted without reweighing the bars in certain circumstances. Rule 11.12.10 states that bars sourced from an LBMA-approved weigher are not required to have the weight incised on the bar, but must be accompanied by a digital bar list. And this reliance on digital lists is the digitization of trust. It removes the physical trust but verify element and replaces it with trust the spreadsheet. If the digital list says there are 40 million ounces, the market accepts it. But digital lists can be hacked. Digital lists can be altered. Digital lists can be rehypothecated. In our theoretical bar list number 409 scenario, the auditor isn't denied access because of a lost key. They are denied access because the digital list doesn't match the physical floor. And maybe the digital list says section G, row 4, but section G, row 4 is empty. The metal was shipped out last week to Tesla or Samsung to cover a desperate industrial shortage. The bank didn't update the list because they didn't want to spook the market. They were hoping to get new metal in before the audit. They got caught. This just-in-time inventory management works for grocery stores. It works for car parts. It does not work for a fractional reserve banking system operating at 400-to-1 leverage. When you run a vault like a grocery store, eventually you run out of milk. And in the silver market, running out of milk means the collapse of the fiat currency pricing mechanism. The audit is the only thing standing between the illusion and the collapse. And if the audits are performative, if they are restricted, sampled, or reliant on digital blind faith, then we are flying blind. We are trusting the arsonist to be the fire marshal. Now, we are going to leave the vault and enter the trading room. We are going to look at the math that drives this fraud. We are going to explore the 400-to-1 ratio and show you exactly how a $50 billion physical market is being controlled by a 10 trillion paper monster. The ghost isn't just in the vault. The ghost is the entire market. In the first section, we stood outside the vault and realized the physical metal might not be there. Now, we are going to open the books and realize that the paper promises definitely are there, way too many of them. The central pillar of the ghost inventory scandal is a concept called the paper-to-silver ratio. This is a measure of how many paper ounces are traded or held in derivative contracts for every 1 ounce of physical silver that actually exists in the registered vaults. According to various financial clocks and industry watchdogs like the U.S. debt clock and mining analysts, this ratio has exploded in 2024 and 2025. Some estimates put it at 250 to 1. Others, more alarming, put it at 400 to 1. Let's digest that number, 400 to 1. Imagine you go to a coat check at a crowded nightclub. You hand over your coat, and the attendant gives you a ticket. Now imagine that the attendant prints out 399 copies of your ticket and sells them to other people in the line. There are now 400 people holding a ticket for your coat. As long as everyone stays on the dance floor, the system works. The attendant has pocketed the cash for 400 coats. He is rich. But at 2 a.m., when the lights come on and the music stops, 400 people are going to rush that counter. Only one person, presumably you, is going to leave with a coat. The other 399 are going to leave with a worthless piece of paper and a lot of anger. This is the COMEX silver market. The coat is the 1,000-ounce bar. The ticket is the futures contract. The attendant is the bullion bank. The dance floor is the speculation phase where nobody asks for delivery. We are currently at 1:55 a.m. The music is fading. The lights are flickering. Why do regulators allow this? They allow it under the guise of liquidity. They argue that futures markets exist to provide hedging for farmers and miners, and that speculators provide the necessary liquidity to ensure there is always a buyer and a seller. They claim that cash settlement is a valid feature of the market. If you have a ticket for the coat and there is no coat, they will just pay you the cash value of the coat. But here's the fraud. The cash value is determined by the trading of the 400 tickets, not the one coat. Because there are so many tickets, the perceived supply of coats is massive. Look at all these tickets. There must be thousands of coats. This artificial supply suppresses the price. So when the default happens, they will pay you the suppressed price of the coat, maybe $30 or $50, when the actual coat, the physical bar, is trading on the black market for $500 because it is rare. You get paid in devalued paper. They keep the real asset. Is this conspiracy theory or is it conspiracy fact? The defenders of the status quo will tell you that the banks would never do this. They have compliance departments, they have regulations. Let's look at the record. Let's look at Morgan Stanley. In 2007, Morgan Stanley settled a class action lawsuit for $4.4 million regarding their precious metal storage practices. The allegation was simple and devastating. Morgan Stanley charged clients storage fees for physical silver bars that did not exist. Clients thought they owned allocated metal. They were paying insurance and storage on specific bars. But when they asked for the serial numbers or when they audited the accounts, it turned out Morgan Stanley was just taking their money and giving them a digital credit. There was no metal. It was a fractional reserve scheme. They were charging rent on a ghost apartment. The lawsuit revealed that this practice was not an error. It was a business model. By not actually buying and storing the real metal to back the customer's purchase, financial firms can greatly enhance their bottom line profits through the free use of the customer's funds, noted analysts at the time. If Morgan Stanley, a blue-chip, too-big-to-fail Wall Street bank, was doing this in 2007, why should we believe they stopped? The incentives haven't changed. In fact, they have gotten worse. The demand for silver has grown due to solar and EV production, making physical sourcing harder. The temptation to sell paper silver instead of sourcing real silver is higher than ever. And it's not just Morgan Stanley. Look at MF Global in 2011. They raided segregated client accounts to pay for their own bad bets on European bonds. $1.6 billion vanished. Look at the LME nickel squeeze in 2022. When the paper short got squeezed by physical reality, the exchange simply canceled the trades. They deleted the tickets to save the attendant. These aren't theories. These are court cases. These are settlements. These are historical facts. The ghost inventory scandal we are discussing today is simply the logical continuation of this pattern of behavior. Bar list, no armor 409, is just the 2025 version of the Morgan Stanley storage fee scandal. Let's get deeper into the math of rehypothecation. This is the mechanism that turns one bar into 400 claims. Rehypothecation is the practice where a bank or broker uses assets held as collateral for one client to back its own trades or trades for another client. In the silver market, it works like this. Miner A deposits 1,000 ounces at the vault. Bank B counts that as an asset. ETFC buys silver from Bank B. Bank B allocates that 1,000 ounces to the ETF. But the ETF's prospectus often allows for unallocated storage or sub-custodian arrangements. Bank B then leases that same silver to industry user D, who needs it for a factory inventory hedge. Speculator E buys a futures contract from Bank B. Bank B uses the same silver as the hedge for that short position. Who owns the silver? The miner, the ETF, the industry user, the speculator? According to the contracts, they all have a claim, but the silver can only be in one place. When the market is calm, this doom loop generates massive fees for the bank. They get storage fees from the ETF, lease fees from the industry user, and trading fees from the speculator. It is a money printing machine, but volatility breaks the machine. If the price of silver spikes, say due to a Tesla supply shock or a geopolitical crisis, all parties scramble to secure the asset. The industry user demands delivery for their factory. The ETF sees inflows and needs to verify its holdings. The speculator stands for delivery to capture the arbitrage. The bank has to choose who gets the metal. Usually, the industry user gets priority. The ETF and the speculator get cash settled. But if the ETF turns out to be empty, confidence in the entire financial system shakes. This is why the audit of bar list number 409 is so dangerous. It threatens to expose the rehypothecation doom loop. If the auditor says this bar is encumbered, the ETF has to declare a default. The stock price of the ETF collapses. The investors sue. The regulators wake up. The 400-to-1 ratio tries to unwind all at once, and 400-to-1 doesn't go. It explodes. What does a run on the bank look like in the silver market? It doesn't look like lines of people outside a building. It happens digitally, and it happens fast. It starts with the EFP, or exchange, for physical market breaking down. Usually, traders swap futures contracts for physical metal using EFPs. It's a smooth mechanism. But recently, we have seen EFPs failing to generate delivery. Traders are being offered cash incentives not to take delivery. We'll give you spot plus $1 if you just roll the contract over, the bank says. Then spot plus $2. This is the bribe. They are bribing you to keep the ghost inventory secret. But eventually, a player comes along who cannot be bribed. A strategic player, a nation state or a massive industrial conglomerate. They don't want the dollar. They want the silver. When they stand for delivery of 10 million ounces, and the vault only has 2.5 million ounces, and half of those are bar list MAR 409 ghosts, the default triggers. The exchange will likely declare a force majeure event. They will suspend trading. They will freeze the accounts. They will say, due to irregular market conditions, we are suspending physical delivery. This is the moment the paper price and the physical price decouple permanently. The screen might say silver 35 dollars, but on eBay, on AppMex, at your local coin shop, the price will be 100 dollars, and even at 100 NOx, there will be no buy button. It will say out of stock. This is the unobtainium phase. The 400 paper holders are stuck with their $35 cash settlement. The one physical holder has an asset that is repricing to infinity against a collapsing currency. The math forces this outcome. You cannot maintain a 400-to-1 lie forever. Eventually, the truth, the physical truth, demands to be heard. Now, we are going to discuss the fallout. What happens the day after the default? How do you protect yourself? And why is silver potentially the most undervalued asset in the history of mankind, given this ghost inventory dynamic? We will also look at the safe haven argument. If the COMEX fails, where does the price discovery go? Shanghai, the blockchain? The ghost is about to be busted. Welcome back. We have analyzed the ghost bar scenario. We have crunched the 400-to-1 numbers. Now, let's look at the endgame. What happens the day the COMEX effectively dies? I don't mean the building burns down. I mean the day it ceases to be the price discovery mechanism for silver. This event is known as the decoupling. Historically, London and New York have set the price of silver. They are the paper makers. But in the East, Shanghai and India, they are the physical takers. For years, the East has been happy to buy physical silver at the suppressed paper prices set by the West. It has been a massive wealth transfer. The West prints paper shorts. The East takes real bars. The audit failure of bar list number 409 would be the catalyst that ends this arrangement. If confidence in COMEX delivery fails, the arbitrageurs will stop playing. Currently, if silver is $30 in New York and $35 in Shanghai, a trader buys in NY and sells in Shanghai. This keeps the prices roughly linked. But if you can't get the metal in NY, if you buy the contract but get ghosted, you stop buying. The link breaks. The COMEX price becomes a zombie price. It might trade at $30 forever, purely for cash settling bankrupt entities. Meanwhile, the Shanghai Gold Exchange or a new commodities exchange becomes the reference price, and that price will be based on physical availability. We are already seeing the cracks. The premium on Shanghai silver has been consistently higher than New York, sometimes by 10% or more. This is the market screaming that physical metal is worth more than paper promises. When the decoupling becomes official, when a force majeure is declared, we could see a limit up open in Shanghai. Silver could jump from $35 to $50, then $75, then $100 in a matter of weeks. It wouldn't be a bubble. It would be a repricing. It would be the market finally discovering the true clearing price of silver when you remove the 400 ounces of paper supply. It's like removing a beach ball from underwater. It doesn't fly into the air. It simply returns to the surface where it belongs. Silver has been held underwater by paper for decades. We need to talk about the legal trap awaiting paper investors. It is called force majeure. Every futures contract, every ETF prospectus, and every unallocated account agreement has a force majeure clause. It basically says, in the event of acts of God, war, government intervention, or market disruption, we are not liable for failure to deliver. Market disruption is the key phrase. A squeeze caused by ghost inventory is a market disruption. So legally, the banks are covered. They don't have to give you the silver. They will invoke cash settlement. Rule 1110s and others in the CME playbook allow for alternative settlement procedures when delivery is impossible. They will determine a fair value for the settlement. Likely, this will be the last traded price before the halt. So, if silver freezes at $62, they will send you a check for $62 per ounce. You might think, that's fine, I made a profit. But remember, the real price on the physical market is now $150. You take your $62 check and go to a dealer to buy silver. The dealer laughs. I can't sell you silver for $62. The price is $150. You have lost 60% of your purchasing power instantly. This is the cash trap. You get your nominal dollars back, but you lose the asset. This happened in the nickel squeeze. Traders who were long nickel had their trades canceled or settled at prices far below the market peak. They were made whole in cash, but they missed the windfall. This is why we say, if you don't hold it, you don't own it. The ghost inventory is a weapon used to trap you in the paper system. The audit failure is the warning shot. Why go through all this trouble? Why is silver worth the risk of navigating this fraud? Because silver is the only asset that is both a monetary metal and an industrial necessity that is currently priced below its 1980 high when adjusted for inflation. In 1980, silver hit $50. Adjusted for inflation, that is over $150 today. Currently, silver trades around $62. It is arguably the most undervalued asset on the planet. But the ghost inventory scandal adds a new dimension: shortage. We are not just betting on inflation, we are betting on a physical shortage. Solar panels consume 20% of annual supply, EVs consume massive amounts, AI servers and 5G towers need silver. The industrial world needs the metal. They cannot use paper silver to build a solar panel. You cannot conduct electricity with a futures contract. Tesla needs the physical bar. Samsung needs the physical bar. This means there is a put option under the silver price. The industrial users will step in and buy every ounce available if the price dips. And if the price explodes, they must pay it. They have no choice. The cost of silver is a tiny fraction of the cost of a Tesla or an iPhone. Even if silver goes to $500 an ounce, it only adds a few dollars to the cost of an iPhone. Apple will pay it. This makes silver quid giffen good in this scenario. Demand might actually increase as price rises because panic sets in. The ghost inventory suppression has acted like a coiled spring. It has kept the price low, which discouraged mining and encouraged consumption. This has depleted the above-ground stocks. Now, the vaults are empty or full of ghosts. The mining supply is flat. The demand is vertical. The math is inevitable. When the ghost is busted, the repricing will be violent, and it will be permanent. We will never see sub-$30 silver again. We might never see sub-$50 silver again. So, what is the actionable advice here? How do you avoid being a victim of bar list number 409? First, audit your own holdings. If you own unallocated silver in a pool account, sell it. Move to allocated storage where you have the serial numbers of your specific bars. Better yet, take personal possession. If you own an ETF like SLV, understand that you are a creditor, not an owner. You are exposed to the sub-custodians. Consider funds that allow for physical redemption or hold the metal yourself. Second, watch the premium signal. The canary in the coal mine is not the spot price. It is the premium. If you see the spot price drop, but the price of silver eagles or maple leafs goes up, that is the decoupling. That is the ghost being exposed. Don't be fooled by the spot price crash. That is the paper market dying. Buy the physical dip if you can find it. Third, diversify jurisdiction. If the COMEX and US banks fail, you want access to markets outside that system. Singapore, Switzerland, Cayman Islands. Storage facilities that are outside the U.S. banking regulatory net are safer from bail-ins or confiscation orders. Fourth, stay educated. The mainstream media will not cover this until it is too late. They will call it a glitch. They will call it volatility. You need to follow the data. Watch the daily CME warehouse reports. Even if they are manipulated, the trends tell a story. Watch the eligible to registered transfers. Watch the open interest numbers. The story of bar list for 409 is a warning. Whether it is a theoretical scenario or rumor circulating on the trading floor, the structural flaw it represents is real. We have a market built on 400 to 1 leverage. We have a market where audits are imperfect and access can be denied. We have a market where inventory is disappearing at a record pace. The ghost is real, the silver is not. When the music stops, and it sounds like the band is packing up right now, make sure you have a chair. And make sure that chair is made of physical metal, not paper promises. This is the greatest wealth transfer in history waiting to happen. The audit failure is the starting gun. Don't be left holding the ghost.